We're glad to have you back. Now, again, the World Bank's October 2025 reports NDU titled From Policy to People, Bringing the Reforms Gains Home, paints a mixed picture, saying growth is up, inflation easing, foreign reserves are climbing, yet poverty and food insecurity remains entrenched. Now, it urged Nigeria to remove trade barriers on food and intermediate products as a solution to combating food insecurity. It estimated duties on food importation at between 5 to 35%, which is considered prohibitive and serves as a major cause of food inflation. Now, while the macroeconomic reforms have averted fiscal collapse, the report said that they have failed to halt a dramatic surge in poverty. Now, government has argued this, like I said earlier, with the number of poor Nigerians projected higher than what it used to be. Now, the report uncovers several critical, previously unreported crises, including historic shifts that have seen state governments collectively receive more federal allocation than the federal government for the first time in the nation's history, crippling federal government's capacity to fund national projects. Staying on this report, very important one, Nabila Mohammed is my guest. She's an investment analyst with Chapel Hill Denham. Nabila, it's very good to have you join me to discuss this topic. Good afternoon, Nabila.
Good afternoon, and thank you for having me.
All right, then, I think we should start with this good news coming in from the investment angle. You are an investment analyst, and I know this will excite you. We had Shell Bonga, and that was a very good one. We were rejoicing and rejoicing, and now Shell's final destination again has come for a $2 billion, I think, with regards to a new gas project or something. What does this mean for us? President Tinubu has already commended this development, but what does this really mean looking at the investment climate of Nigeria?
So it just simply means that they are seeing something right that has been put in place, and for them to see that thing right, that is what that has already brought about this news, and this is what we are seeing right now. So if there is something that is going right in the reforms in terms of that sector or that space, then we'll definitely see more investors try to stake or put a stake in their own way in that area. And that is what we have seen with the reforms so far, especially or particularly in the oil and gas sector, where we are having, the PIA that is, that was introduced. And that alone just involves a lot of transparency that is shaping the narrative in that sector. So it is not a surprise. It's something that I think is laudable, and we may likely see more players or more, interest, being poured as a result of this going forward.
Interesting stuff there. We've had some executive orders in the oil and gas industry by the special advisor to the president, or instituted by the special advisor to the president. And this seems to be driving so much interest in that space. Aside the downstream that has been faced with one or two challenges, you already mentioned that we might or we should be expecting more. But I was concerned at a particular time about the implementation of the PIA. Are you satisfied with it?
So, there's always that argument that we are very big on, executing a lot of orders, but when it comes to implementation, there is always like a setback or something like that. But the idea is, if it has already been signed, then implementation should be the next step. And it may not be something that will be rapid or be very fast, but it should be done step by step, and eventually we should see it materialize. So I think that we are still on that journey in terms of implementation. And if they do more in terms of what the Act has already put in place or laid down in terms of the operationalization of all the players in that sector, whether it's upstream, downstream, then we may see, much more improvements when it comes to the implementation of the Act. So it may not be as rapid, like I earlier mentioned, but I think we are taking some steps, which I believe we should see fully bloom, come 2026, alongside other supporting policies, of course.
Great stuff now. Back to the IMF and World Bank report, and I'm taking the point of social protection, which they are talking about, saying it's kind of dipped. And maybe that's why they are talking about the number of those that have drifted into the poverty line. Let me ask you first, I'm sure you've read that report, what you make of it. Like I said earlier, my first guest, it's not just all negative in that report if you really read deep into it. But what does it mean for you, an investment analyst?
So indeed, it is not all negative in that report. And what I would like to first clarify is that the title of the report itself says what it is talking about. They have agreed that indeed we have put in some reforms in place to set things right across different sectors. But they have also alluded to the fact that these policy reforms are not really transmitted to the people involved. And that is where I would just like to say that, yes, in as much as we've done so many things right over the past 12 to 24 months, it means that there is still more work to be done in terms of getting the people to buy into the reforms that have been put in place. And let me explain what I mean. So we may see a lot of macro gains from a federal government standpoint or from a federal level standpoint, but we have sub-players that are more closer to the people. I'm speaking about the subnational, in this case, the state government, the local government, that can really help in transmitting whatever is, being formed or formulated at the federal level down to the people. So if it means that on the state level and local government level, we can get some of these reforms, being impacted directly to the people, I'm very sure we'll really start to see buy-in from people generally, that's from the public. So we need to really see public buying into the reforms that the federal government is putting in place. Yes, from a macro standpoint, it is good, but if you speak to a daily person or average person on the road or on the street and ask, how are they really experiencing this, they will not really share that same sentiment. And I believe that is what the World Bank report is really saying that the country will now have to address. Now that you have formulated this policy, you have to make sure that these policies are really felt by the people that they are meant to, protect eventually. And that is what the World Bank report is saying, that yes, you have tried your best in terms of fighting inflation. We're seeing improved growth across sectors, even though it is uneven, which I would like to say that we need more to be done across other key sectors of the economy, like the agri space, in fact, particularly the agri space. And that is where they mentioned in the report that food inflation is still a problem. We still have structural challenges in that space that need to be addressed. The growth in that sector is still very slow. And it's something, again, that the World Bank report mentioned that the government would have to look into. Yes, we like what we have seen so far in the industry space. We like the whole pickup in crude oil production. On average, we average around over 1.6 million barrels per day from 1.5 that it was last year. We've had more protection along the pipelines, and we've seen improved output. We've also seen better output in terms of oil refining, largely as a result of Dangote refinery. And that's what has happened so far in the industrial space, and that's why we saw it record such growth. So if you can you also see something similar happen with the agri space, then it will be a broad-based, growth across the economy. And all that's where we really see most of, or should I say, we really see most of the fact that people are being impacted by poverty in that space, and that is the agricultural sector. Because when you go look at the other players or the other sectors of the economy, that's the industry and services, that's where we see more big players. But the players that are really the people involved, that's the people like the daily market lady or market woman on the street, that's where they play more under the agri space, crop production. And if we have the right structures in place, then it will translate to the people, and these policies will, be felt by them. And I believe that's generally speaking what the report is talking about and what they expect the government to address going forward, alongside all the policies so far that they have put in place.
I agree with you so very well that we're getting the macro right, but the micro seems to be the issue. Now, the World Bank also alluded to the fact that there's been increased revenue. And we all know that. Even at the last time, President Tinubu talked about the increase in non-oil revenue and what has already come in as at August this year. Also, we know that federal allocation to states and local governments have increased. So when we talk about all of this, in some quarters, the argument is the states and the local governments have increased revenue. And they also have a role to play in addressing this issue of poverty. Like the president said at one of the meetings, they need to water the grass around their environment. Do you think that this is really trickling down? Now, I'm talking about the increase in allocation, because it's key that it gets down to the people. They need to feel the impact of the increased resources.
So most definitely, that is the truth, and that was exactly what I was trying to say. That there's so much that can happen at the federal level, but the federal level is not as close to the people as state as well as local government. Now, given that they have had increased revenue flows, the next step for these subnationals as well as the local governments to take would be to channel those funds into projects that would be friendly in terms of making the environment conducive for the people that they are managing, that are within their jurisdiction. So if there's anything at all that these states can respectively do to improve the state of infrastructure within their jurisdiction, and that to enhance the business environment and make it more business friendly for the people that live there, then they should do it with these funds that they've been able to rake in, or they have that has increased over the period. And this is where we start to, see states, attract foreign direct investment into their own coffers, and that would help them to grow the condition or improve the condition of the people within their jurisdiction. So the onus indeed is on the states and local governments to actually bring this to the people themselves, because the federal government can only formulate and do what we can do from a macro standpoint. But as it comes down, when we look at who is closest to the people, the local government can do better in terms of channeling the funds to projects that would support the improvement in terms of livelihood of their people. Different states have different issues. So I would like to say that what they should look inward and see what they are lacking, and look at projects that when they do them, they would make the lives of their people better. And that is what would, really bring about the broad-based change or economic growth and expansion that we need to see going forward.
I think that needs to happen as fast as possible. Let's talk about, you've mentioned FDIs and FPIs, and we are well informed, or the figures that we see, we know that we have more of FPIs coming in. That's foreign portfolio investments, for those that might not understand what FPI stands for, and other than foreign direct investments. And some will tell you FPIs remain hot money. They only come in because of the stability in the foreign exchange market, coming to sweep all of the profit in our stock market and, of course, other markets, equities market, fixed income and all of that. Treasury bills, everyone comes to put in their money and want to just take the profit. But let me ask you, moving forward, are we getting to that point where the level of confidence, either in our stock markets, either in our markets generally, that will now start to drive sustainable investments moving forward?
So if we're speaking about level of confidence, recently we did hear that the FTSE Russell has, put Nigeria as a watch list, meaning that we are doing things right and could possibly be readmitted into the frontier market index as a frontier market. And that's a positive news. That's a positive, that shows some level of confidence that we are garnering from the foreign community. So I'll say from that standpoint, or based on that news alone, it's something that indeed we are doing right. And this year alone, we've had two of the, international rating agencies, raise our rating as a country. And that again also speaks to some level of improvement in terms of confidence from the international community. So if we're speaking about foreign direct investment, if we, sustain the momentum that we have already started through this, reform journey that we've been on, we may likely see more FDIs coming. Now, if we also fix the structural issues that we have, just speaking to confidence alone, I've already addressed some of the things that we've seen garnered from the international community. Now, if we now look inward, it's one thing to get the right perception out there, but it's also another thing to fix what is inside. And the inside is where we now start talking about the infrastructural, development that we need to ensure is in place. Now, if we're looking at continuous or sustained power supply, if we're looking at improved security around, especially food producing regions and generally across the country, all that will bode well, and it will, support the confidence that we're already getting from the foreign community. So those two will really need to be in place for us to see improved FDI flow. Yes, FDIs have come. In fact, we've seen the impact. Yesterday, our currency has gained well over 5%. We are currently at 1,400 from the 1,500 that we closed last year at. And it just means that we're seeing them, bringing their funds into the country. And for them to bring in their funds consistently into the country, it will definitely support the level of our effects in terms of exchange rates. And that's what we're seeing play out. But we can't rely on that. And that is where, just making sure that the ground is set for these returns to come back, that's the FDIs to come back, it will be very important for us to do so we do not rely so much on the foreign portfolio investors, because the moment there is any, even if it's just a whiff of something that is going to maybe affect their investment, and they take flight. And when they take flight, then we will now be back to a much more higher value in terms of exchange rate. And we do not want that. We've come so far to now have to go back on a number of things, all in the name of a foreign investor decided to take flight and, go back to any other place. And again, it's going to also be supportive, especially with the fact that we are expecting an additional rate cut for the US Fed. And that would mean that these investors that are already in the US would be looking for other areas that they can get higher returns. And we still have our interest rates at a very high level. So we may see them come into the country and take positions, and that should keep them for a while. But again, relying on that going forward shouldn't be the case. So if there are more reforms that they will need to do to ensure that the infrastructure is right, given that we've already gotten some level of confidence from the foreign investor community, then why not? That would, bring more foreign direct investment into the country, and we may rely less on the foreign portfolio investors to, keep our currency stable.
If you can do this in 1 minute, looking at the stability in the FX market again, I guess you mentioned 1,400, right, at the moment?
Mm-hmm.
And if
not exactly 1,400,
I think 1,400 and a little, yes. I think it's about 1,400, 1,450, 1,430, depends on where you're changing it. But my question really is, we talked about being appropriately priced. At the rate we are moving, do you think that we could still see a major decline before the end of the year?
I won't be surprised, because so far this year, in terms of FX flows into the market, we are well above $350 million. And that's the highest in the past 5 years in terms of average liquidity, FX liquidity flows into the market. And that is a positive, if you ask me. So if we see that level of FX flows through the rest of the year, we may even eventually end the year at that 1450 level for 2025 comfortably. And we will not see it get to 1,500 before we end the year if we sustain that level of FX flows in the market. And again, it's even positive for them. And again, it's even positive because we're seeing banks now, selling or in USD to their customers, unlike what we had previously. They did not used to, allow that liquidity flow out because they didn't have enough. But now we're seeing them do so. So it means that something is actually working right.
I tell you, even our cards now can work anywhere. Where you travel, you can use your cards. Kudos to the Apex Bank. Nabila Mohammed, it's always interesting having you join us on the program and your contributions. Thank you so very much. I do enjoy the rest of your day. Investment analyst, Chapel Hill, Denham, Nabila Mohammed.
Thank you for having me.
All right.